now we're going to be talking about how inventory is presented on the balance sheet. And as you know, inventory is an asset, and it's also presented as a current asset within the balance sheet. Assets, they have a debit nature, so we expect inventory to appear on the debit side of the trial balance. And it also has an impact on the income statement because we calculate cost of goods sold based on the remaining balance of inventory. But now let's focus on how inventory is prepared on or presented on the balance sheet. So as it says here, inventory is usually reported in the current assets section of the balance sheet. In addition to this amount, the following are reported. So we have to report the method of determining the cost of the inventory, whether it was LIFO, FIFO, or weighted average, and it's usually written next to the inventory account. Also, the method of valuing the inventory, whether it's cost or lower of cost or market. So it's also presented on the face of the balance sheet. And this is an example of how it looks on the balance sheet. We have a Morning Joe balance sheet for December 31st, 2016. And as you can see here, we have the account inventory under current assets. And it says lower of cost or net realizable value. And then they say the cost is based on first in, first out method. So that's typically how it's presented, and the total value is $120,000. So now let's talk about errors related to inventory and how it can affect the financial statements. And as I just said, inventory has an impact on the cost of goods sold calculation. That's why it also affects net income presented on the income statement. So any errors in merchandise inventory will affect the balance sheet and the income statement. Some reasons that inventory errors might occur include the following. Things like physical inventory on hand was miscounted. So when the people were doing the physical count, they miscounted the inventory. Or costs were incorrectly assigned to inventory. Or maybe inventory in transit was incorrectly included or excluded from inventory. And that's always a problem because inventory in transit, they're not on site. So if they should be added to the inventory balance and nobody saw them, maybe they can get missed. So consigned also inventory was incorrectly included or excluded from inventory. Consigned inventory is the inventory that's held by others to be sold for the benefit of the owner of the inventory. We can be the consignor and we can also be the consignee. So it depends on whether we are selling inventory for another company or we're giving our inventory to another company so they can sell it on our behalf. So inventory errors often arise from merchandise that is in transit at year end. As I told you, usually year end is the critical thing because we don't know whether we should include it or not. So shipping terms determine when the title to merchandise passes. So when goods are purchased or sold, FOB shipping point or free on board shipping point, title passes to the buyer when the goods are shipped, even though they haven't arrived at the buyer's warehouse. So that's a problem. If I'm a buyer and I bought some inventory items and the agreement was free on board shipping point and they're still in transit, I should count them as part of my inventory. But in many cases, people might miss it because it's not in the warehouse. When the terms are free on board destination, title passes to the buyer when the goods are received. And again, if I'm a seller and I'm selling inventory based on an agreement that says free on board destination and the items are still in transit, I might not count it in my inventory even though I still own the inventory because it's not going to the title is not going to pass to the buyer until it reaches their warehouse. So these are the scenarios where we have to be extremely careful when it comes to the inventory that's still in transit. So inventory errors often arise from consigned inventory. Manufacturers sometimes ship merchandise to retailers who act as the manufacturer's selling agent. The manufacturer, called the consignor, retains title until the goods are sold. Such merchandise is said to be shipped on consignment to the retailer, which is called the consignee. Any unsold merchandise at year end is part of the manufacturer's or the consignor's inventory, even though the merchandise is in the hands of the retailer, which is the consignee. So again, that can be a problem because I can be a manufacturer and I have some inventory that was sent to a consignee, and for some reason these inventory items are not sold yet, and because I don't have them in hand, I would just not count them as part of my inventory. So my inventory in this case would be undervalued. So this is, I think, a very important chart because it tells us the effect or the impact of beginning inventory and ending inventory on cost of goods sold, gross profit, and net income. And one thing I want you to just understand that gross profit and net income, they always go in the same direction. So if one is overstated, net income would be overstated because there's direct relationship between both of these. So if beginning inventory is understated, cost of goods sold would be understated. And gross profit and net income would be the opposite, it would be overstated. If beginning inventory is overstated, then cost of goods sold would be overstated, and the gross profit and net income would go in the opposite direction, which would be understated. And by the way, overstated and understated means they're going to be either over their actual value or under their actual value. If end inventory is understated, then cost of goods sold would be overstated. So these work opposite direction. So if ending inventory is understated, then cost of goods sold would be overstated, and then gross profit and net income would be understated. So one thing I want you to see that gross profit and net income, they always have opposite direction to cost of goods sold. Cost of goods sold works in the same direction with beginning inventory, but they work opposite direction with ending inventory. So last thing here, if ending inventory is overstated, cost of goods sold would be understated, and both gross profit and net income would be overstated. Now let's talk about the effect of inventory errors on the income statement after 2 years. And the reason we're bringing this up is because, as we've seen, beginning inventory has an impact on cost of goods sold and net income in one way, and then the end inventory has an impact on cost of goods sold and net income in a different way, or in opposite way. So that creates a problem. It's actually not a problem. It solved the problem, because if you think about it, end inventory of 1 year is the beginning inventory of the next year. So if we made an error with our end inventory in 1 year, that would have an impact on cost of goods sold and net income in one direction. Then this same ending inventory overstatement or understatement would be a beginning inventory in the following year. It's going to have an opposite impact on cost of goods sold and net income in the following year. So let's see this with an example. So here we have 2016 income statement, and as you can see here that we have our beginning inventory, that's 55,000, and that was correct, there's no problem here. But our end inventory in 2016 was incorrectly understated. So you can see the correct value should have been 60, and now it's corrected as 50, or it's recorded as 50. So when end inventory is understated, how this is going to affect cost of goods sold, you can see that cost of goods sold has been overstated. It shows as 655, the correct value should have been 645. And you can see that cost of goods sold is 325. In other words, it's understated compared to the correct value. And the net income would be the same thing. So that led to a $10,000 understatement of net income. This ending inventory understatement would be the beginning inventory, and it would be also understated in 2017. So the correct value should have been 60. Now we're showing it as 50. So how would that affect our cost of goods sold? You can see that when beginning inventory is understated, that would lead to cost of goods sold being understated too. So it shows 680, but the correct value is 690. And how would that affect gross profit? Gross profit would be overstated. Okay, the correct value is 410, but we're showing 420. And then finally, net income is also overstated. The correct value is 290, but we are having $300,000 here. That's the incorrect value. So in 2016, the error or the error in ending inventory led to a $10,000 understatement of net income, and the same error when it moved forward to 2017, it led to a $10,000 overstatement of net income. So you can see, as it says here, net income is 0 for 2 years because 1 year it's understated, the other year is overstated, so there's a wash. So inventory errors reverse or cancel so that the combined net income for the 2 years of 525, which is both of these net incomes, is correct. So if you add 225 and 300, it's 525. If you add 235 and 290, again, it's 525. So this is just an example that shows you that when we make an error in inventory, it just clears in the following year. Now let's see the effect of inventory on the current period's balance sheet. And I think this is just common sense, because when your ending inventory is understated, inventory would be understated because that's the one that appears on the balance sheet. Your current assets would be understated, total assets would be understated, stockholders' equity, and retained earnings would be understated. And if ending inventory is overstated, then we'll see that this would have the exact same impact on inventory, current assets, total assets, and retained earnings. So this just, I think, is very clear, and it's just common sense. So here we have a checkup corner. I'll leave that for you to work on to see how the effect of inventory error after 2 years. Now for the last part of this chapter, we're just going to go over one important ratio called inventory turnover. So inventory turnover measures the relationship between cost of goods sold and the amount of inventory carried during the period. It measures the number of times inventory is turned into sold goods during the year. And how we calculate it, it's basically cost of goods sold, which we bring it from the income statement, and we divide it by average inventory. And how we get the average inventory, it's simply the beginning inventory plus ending inventory divided by 2. So we know on the balance sheet we have the ending inventory. So where can we get the beginning inventory from? Beginning inventory is the ending of last year. So we get ending of last year and ending of the current year, add them together, divide them by 2, and that would be our average inventory. And it just simply shows the number of inventory times we buy inventory and sell it. The higher the inventory turnover, the more effective the selling process. So let's see this example for a company that we all know, which is Best Buy. They have these numbers. They have the beginning inventory of the year, ending inventory for the year, and they also have their cost of goods sold, which is about the same. It's very similar from year 1 to year 2. I want you to see that end of year 1 is the beginning of year 2, and this is what we're talking about. Like an ending value for 1 year is the beginning for the second year. And now the average inventory, we simply add these two values, divide them by 2, add these two values, divide them by 2, and here are the average inventories for year 1 and year 2. And the inventory turnover ratio is basically the cost of goods sold divided by average inventory. And you can see in year 1 was 5.1, in year 2 5.9. Since the numbers increased slightly, this shows that there's improvement in the inventory turnover. Another related ratio is called the number of days sales in inventory, which measures the length of time it takes to acquire, sell, and replace the inventory. How we calculate it, it's basically average inventory divided by average daily cost of goods sold. So let's see an example of how we can calculate that. So we have the exact same information, all right, and we got our average inventory here, which is 52.75 and 60.78 for year 2 and year 1. And then we need to get the average daily cost of goods sold. So how we do that, we just get the cost of goods sold divided by 365. And we get 85 million and 85.5 million. So you see the values are very close. To calculate the number of days sales in inventory, we get the average inventory and divide it by average daily cost of goods sold. And you can see in year 1, it took about 71.1 days to sell the entire inventory and replace it. In year 2, it took 61.6. So that we see some improvement between year 1 and year 2 when it comes to the number of days it takes to sell the entire inventory. So by that, I just want to conclude chapter 6, and I want to thank you for listening. This is an important chapter, and I think we have to spend some time making sure that we understand it very well.